Sajjid Chinoy, India economist at JPMorgan, is now joining us live. Sajjid, thank you so much for taking out time for us. Demonetization is now behind and we've started to get initial data, whether you talk about auto numbers, PMI numbers. What is your initial reading on the post data that markets have got so far?
So I think we need to step back and just first, tell ourselves that the drivers of the growth slowdown that we had anticipated the morning after demonetization have changed. The worry the morning after was that there'd be this very big negative wealth shock that the economy would experience, and that could pull consumption down for a couple of years. Thankfully, that doesn't seem to be happening because the bulk of the old tender, as reports suggest, is now back in the banking system. So purely from an economic perspective, that's good news that there won't be a long-term consumption shock. We have to, however, brace ourselves for the fact that there will be a near-term growth hit because the pace of remonetization, will take some time, and households in the meantime will continue to experience some liquidity crunch, particularly in the rural economy. And the early data suggests that there will be meaningful near-term hit. Both the manufacturing and service PMIs were soft. You saw in November and December the largest 2-month decline in the composite PMI since Lehman. But it's not something we should panic about because we know this is going to be a temporary, 2.5 quarter hit, depending on how quickly we can remonetize the economy. So yes, the early data, is a bit sobering between the PMIs and auto sales. I think what is noteworthy in auto sales is that two-wheelers have fallen, 30% sequentially over 2 months. Again, not entirely unexpected given that some two-wheeler purchases are made in cash. And two-wheelers are also a proxy for rural demand, and we know the rural economy would be disproportionately affected.
In terms of two-wheelers or the impact that you saw on the overall auto numbers, could it only be because of the cash crunch, but could be temporary in nature?
That's the sense. Now, the November numbers were a little bit more difficult to interpret because it was the month after Diwali. And so you don't know how much of the payback in November is because of the strength in Diwali or thereabouts, and therefore the seasonal adjustment gets a little bit confusing. But now that we have the December numbers, in fact, if you decompose the numbers, passenger vehicle sales haven't fallen that much. In fact, sequentially, commercial vehicles have picked up. So the internals of the data are a little more constructive than the headline number that auto sales are at a multi-year low. The weakness really is in two-wheelers, which as we discussed, is because they're typically bought in cash, or some fraction are bought in cash, and they also tend to proxy the rural economy. So, again, there will be a hit for a couple of quarters. This is understandable. But the good news is that this is going to be more of a temporary hit, primarily a temporary hit compared to the 1 or 2 year hit that we had worried about if there were to be a big negative wealth shock to the economy. One last thing I'll say that, it's not all gloom and doom. There is already some kind of stimulus in the system in terms of monetary policy. We sometimes fail to appreciate just how much monetary conditions have eased in the last 6 weeks. Bond yield curves around the world have steepened sharply after the US election. The Indian bond yield curve has flattened dramatically because banks have got all these deposits and they have to park them in some asset, and therefore the GSEC yield is down by 40 basis points. Also, banks have begun to cut lending rates. So there is going to be, at least some easing of monetary conditions that in a few quarters from now should kick in and help offset some of the slowdown.
We'll just talk about the rate cuts, but just wanted to understand that you were already of the view before November that there can be a slowdown in the markets, and already the estimates regarding corporate earnings or regarding GDP estimates are slightly on the higher side. Now that number comes down even further?
That's right. So we were of the view that even before demonetization that the economy is going to gradually slow, largely because we had believed that last year's growth acceleration was driven by the dramatic fall in oil prices. Essentially, India benefited from this huge terms of trade shock, which helped growth for 4 to 6 quarters. Now, that was always a one-time windfall. So as that windfall wore off, it was understandable that GDP growth would slow this year. And you had seen that in the first quarter, growth averaged 7.2 versus 7.6 in all of last year. So there was this natural gradual slowing already taking place. Yes, demonetization will accentuate that for this fiscal year, and so we've brought our growth forecast down from 7.2 to 6.7. But I keep emphasizing that, as bad as the numbers may be for the next month or two, the good news is because the growth slowdown is primarily driven by a cash crunch and not by a more enduring wealth effect, it should be temporary in nature.
Right, and now how does this changes in rate cuts by SBI, change this number, or how do you start to see that now leading to better growth or better, lending growth?
What this does is essentially cause us to have a little more conviction on next year's growth forecast for two reasons. Because you see, as the liquidity situation, when I say liquidity, I mean household cash availability improves. I think already in the second half of 2017, one can see a kind of a natural rebound. So for example, if a household did not purchase a two-wheeler because of a cash shortage in November or December, and the situation normalizes by April or May, then they will postpone that consumption to later in the year. So you will see, think of a natural disaster. There's a hurricane. You have a short-term hit in activity, and then activity kind of rebounds once things normalize. So you will get that natural rebound. And to the extent that monetary conditions have eased, you've actually now got the transmission to bank lending rates, which we were all hoping for the last year, in conjunction with the transmission in the wholesale market, suggests that will give some impetus to growth. So it just gives me a little more conviction that, we may end FY17 with a 6-handle number, but FY18, if all remains, if nothing else goes wrong, we should be back to closer to our old growth trajectory.
Right, and what's generally the time lag when you see such big rate cuts and when the growth starts to pick up? What's the time lag that historically we've seen?
There are two transmission lags here. One is from policy rates to bank lending rates, and the second is from lending rates to the real economy. We've finally seen the policy rate to the lending rate transmission. You can think of these lending rate cuts as being responsive to rate cuts that were done over the last year or two. So the first leg of transmission has happened. The second leg typically takes anywhere between 2 to 4 quarters. So I would expect that in the second half of 2017, in some of the interest rate sensitive sectors, whether it's real estate, or consumer durables, that easier monetary conditions should help. Now, again, I don't want to be overly simplistic here. The primary effect of demonetization is temporary. There could be, of course, some spillover effect if the real estate market, for example, remains depressed for a few quarters more. Those effects will linger a little bit longer. And that's where I think easier monetary conditions will serve as an important offset.
Right. In terms of, just wanted to highlight that we heard the management of IndusInd Bank yesterday, and they said that, one of the key opportunities is that, a lot of mid-segment, smaller segment businesses that were not a part of the, banking system now comes into the banking system, and that can make the loan growth very, very high. Do you think tracking the loan growth, tracking the tax, bracket and how many people fall into it would be one of the important conditions for growth targets in FY18?
I think it will, and I think what you're pointing at is the fact that, listen, we've undertaken the cost of demonetization, but there are very tangible benefits of demonetization, and it is, as you mentioned, that you get more activity in the formal sector. Banks now have a bigger set of clients they can lend to. Monetary conditions in the banking system will be easier. Tax to GDP may actually go up because we've got all these deposits, and some tax revenues may come out of that. You will find people migrating, hopefully, from cash to electronic forms of payment, and that creates opportunity for payment institutions. So there are a variety of benefits that that are expected to add up in the months and quarters to come, and I think all of them will contribute to kind of normalizing growth a few quarters from now.
At the end of demonetization, we did see some benefits coming for housing sector, some of the other small benefits coming in for rural areas. Going into the budget, you expect it to be slightly more towards the spending side?
So it's understandable that the government perceives that there are certain sectors in particular that need support, whether it's housing or the rural economy. That it's understandable why the government would want to target some spending in those areas as a counter-cyclical response. I think this year one can at least plausibly expect that from the deposits that have come in, there will be some more tax revenues that the government can garner. And it's perfectly understandable that the government would want to spend that. Even if there were to be a modest slippage in the fiscal deficit path, I'm not sure that would be a deal breaker with markets. I think markets are perhaps already expecting that the fiscal deficit will go from 3.5. It may not go all the way to 3. It may go to 3.2 or 3.3. So I think expenditure to the tune that all of the new tax revenues are spent, and maybe there's a gradual slowing of the fiscal consolidation path is understandable. But what I don't think should happen, and I don't think will happen, is that policymakers panic and overreact, and you get so much spending that you completely violate your FRBM, your existing FRBM path. I think that will be an overreaction for the reasons we've just actually spoken about, that A, this is largely a temporary shock, and B, there is already a monetary stimulus of sorts that's underway. So given that context, I don't think fiscal policy should overreact, and frankly this government deserves enormous credit. Over the last 2-3 years, the evidence has been very clear that they take the fiscal targets seriously, and they understand what the market response will be. So I think more expenditures to be expected. I'm hoping that there is as much focus on public investment in the budget as there is on consumption. My personal bias is consumption, as we said, will normalize when liquidity conditions normalize, but I think we continue to need a big public investment stimulus in this economy that will crowd in private investment. So I'll summarize by saying some degree of expenditure warranted. I hope it doesn't happen at fundamentally altering the fiscal path, which I don't think will, and that there is as much focus on investment as there is on consumption.
Right. In terms of tax cuts, do you expect that corporate tax, individual tax rates may be cut or slabs may be increased? Hard to speculate what will happen. I know on the corporate tax rate front, the finance minister and previous budgets has laid down a trajectory that over time corporate tax rates will come down. So I do expect that those tax rates will come down. I just hope and I expect that in tandem, exemptions are also closed so that it's revenue neutral from the government's perspective. But tax rates I expect will come down. On the personal income tax side, really hard to make a call. There seem to be indications that at the lower end there'll be some tax relief. That's fine. I just hope that whatever fiscal space we have, there's as much use on public investment as there is on consumption. I think given the scenario we painted, we shouldn't overreact on the consumption side at the expense either of fiscal consolidation or public investment. Just a word on infrastructure. Do you expect that a lot may be done for infrastructure? So slowly and steadily, first for roads, then for railways and defense, there was some spend. You expect other sectors to be in focus in this budget?
I think so. I think that's been the leitmotif of all the budgets. I think the government's been serious about public investment, realized that there is a market failure at the moment which is impeding private resources from being invested in physical infrastructure, and therefore that's the opportunity the government must exploit. And they've been focusing on railways, on roads, on power. I expect that there'll be more of the same. Last year we saw that even the budgetary allocations, there were limits. There were off-budget expenditure that the government had envisioned by quasi-sovereigns like NHAI and IRFC borrowing from the corporate bond market and expecting. So I would expect that between the budgetary and the non-budgetary allocations go up. That's really where I think we need to continue focusing on in the next couple of years.
Right. Sajjid, this is Anisha also joining in. Now we've got projections from the World Bank about global growth, and this year they're expecting global growth to be slightly lower than the previous forecast. They're not expecting a big jump in US growth, and they're saying that emerging markets will surprise when it comes to higher growth. What's your expectation of what happens in the US economy, and what will be the resultant impact into flows into emerging markets?
You're again, it's a very good question. On the global front, you're finding this dichotomy where there is better news coming out of the advanced economies. You're seeing in the fourth quarter of 2016, we've been revising up our growth forecast, particularly in Europe. Europe could be the big surprise in 2017. So if European growth is doing better, US growth, there's an economy nearly at full employment. A lot will depend on two things. One is how large is the Trump fiscal stimulus, because that then in part determines what the reaction function of the Fed will be and how quickly they'll be forced to raise interest rates in 2017. Our current thinking is there'll be 3 interest rate hikes in 2017. Now, if advanced economy growth is picking up, but there are also some protectionist tendencies coming out of advanced economies that hurt emerging markets, the cross-border tax, for example, and global yield curves are steepening, which means that global financial conditions are tightening, then the environment for emerging markets in 2017 does not look very promising, because you get hurt by steepening yield curves, and that precludes countries from cutting interest rates to fight any growth slowdowns. So you get hurt by those dynamics, but you don't necessarily benefit from higher growth in advanced economies if most of that is domestic demand and you get these protectionist tendencies. So I'm a little bit more cautious on the outlook for emerging markets in 2017.
Sajjid, but there's also a belief that we are seeing the great rotation from bonds to equities because of better growth, higher inflation. People are moving to riskier assets. Wouldn't emerging markets also benefit from that rotation?
So it really depends. I think you're right. I mean, if to the extent that growth is picking up in advanced economies, you would expect to see, and yield curves are steepening, you would expect to see equities being kind of the favored asset class. The question is going to be how much of that growth spills over into emerging markets, and to the extent that it does not, do tightening financial conditions around the world preclude emerging markets from using monetary policy to fight any growth slowdowns? And if the answer is no, then really the only game left in town in many emerging markets is fiscal policy, but we know that there isn't too much fiscal space across various emerging markets. So I'd be a little bit more cautious about growth prospects and therefore about different asset classes until we know how things pan out with the Trump stimulus, number one, how quickly the Fed will have to raise rates, number two, and are we going to see more protectionist tendencies coming out of advanced economies?
So till we have clarity on all these moving factors, moving issues, what happens to currencies like that of India? We've seen a lot of volatility, weakness in the Turkish lira. The yen has weakened a lot. It's good news for export-oriented economies, but for large importers like India, how weak can the currency get, and what does it really mean for our macroeconomic situation?
So that's what I meant to say, that in the last couple of months you've seen a dollar strength for most part of 2016. It's abated slightly in 2017, and that just reflects the fact that there is more conviction that rates will go up in the US, and when that happens you see capital flowing back from emerging markets to the center country, and that puts some pressure on currencies. In India's case, I think we don't have much to worry about. The environment that India is facing in its balance of payments is dramatically different from the last time there was stress in the world in 2013. The current account deficit back then was close to 5% of GDP. Today, with oil at 50, despite oil at 55, it's tracking less than 1% of GDP. So with a current account of $20 billion and FDI flows anywhere between 30 to 35 billion, India can still witness portfolio outflows, debt and equity, and end with the balance of payments either in surplus or in balance, number one. Number two, we've got a war chest of foreign exchange reserves, so I don't worry about there being any undue pressure on the currency that the Reserve Bank cannot handle. In fact, I think the challenge for the RBI is to make sure that in a world where other emerging markets are depreciating, India's rupee does not become overvalued in real terms and we depreciate in tandem, particularly with China. You've seen in a world of dollar strength, the CNY has been depreciating, and we need to make sure that we don't appreciate in nominal and real terms vis-a-vis China, because they are the biggest threat in terms of cheaper imports. I think one way the RBI is trying to achieve that is to try and keep the nominal effective exchange rate relatively stable, the trade-weighted basket. And what that means is the real exchange rate essentially appreciates by 2 to 3% a year, which is the inflation differential.
Right, but with a weak currency, won't we be importing inflation? What happens to the inflation dynamics within our country when globally inflation is going to be expectedly moving up? You are saying that monetary policy in emerging markets will be constrained. We'll be importing inflation. What does that do to growth?
So there are two different questions here, one on what inflation dynamics and one on what happens to growth because of monetary policy. I think on inflation dynamics, let's appreciate that at least on a trade-weighted basis, the nominal effective exchange rate has been flat. It's not been unduly weak. And that's the measure to look at it. Now, one can argue a lot of India's imports are dollar invoiced, and therefore one should look at the rupee dollar rate, which is legitimate. But even on that perspective, we're depreciating 3 or 4% a year, so that's not alarming from an inflation perspective. Our own sense of inflation is that you're actually seeing food prices come down, the good harvest, pulse prices, the seasonal reduction in vegetable prices is all now showing up in the data. And at least for the next few quarters, with growth going to remain relatively weak, we don't see evidence of much pricing power. If you look at the PMI, for example, input prices did edge up a little bit, but output prices don't go up. So I don't think we have to necessarily overly worry on inflation. Our sense is the first quarter inflation will undershoot the RBI's 5% target, and that may open up a little space in terms of easing. Not in this global environment, it'll be hard to cut interest rates aggressively given what the Fed will do. So we probably think another 25 basis point cut may come through if our inflation forecasts come to fruition.
All right. In this scenario, where do you think investment will flow? If we are not very sure about foreign fund flows, domestic flows have been strong. Which are the sectors you think will see these flows going through? Will it be the consumption-related sectors, or will it be the infrastructure-related sectors?
Well, I think as we discussed earlier, I think that in the second half of 2017, you would expect to see some consumption rebound as liquidity conditions normalize, particularly in the discretionary sectors where consumption would presumably have been hit the most, whether it's auto sales or it's consumer durables or it's housing.
Sajjid, just wanted to understand about GST and say if it is implemented between July or September, whenever it is targeted, or probably towards the timeline of April. Do you think it could be disruptive in the near term because things would change materially how some of the small and mid-sized companies would be operating?
A couple of things. One is, I think, let's not rush the GST in the sense that having a GST that's implemented 3 or 6 months later, but where the design is optimal, I think